All right, so we will get started this morning. I want to thank everybody for joining us. Happy Monday. Just coming in off of a pretty decent weekend with some sunshine and decent weather. So hopefully everybody had a chance to maybe get out and enjoy that to some extent. But today's webinar is focused on the CARES Act. My name is Tanya Belter. I'm the VP of Member Services with the Fox Cities Chamber, and we're excited to welcome Dan Belrud from OneWisconsin Financial Group today. Dan's going to be giving you information in regards to the CARES Act and how that may apply to your small business. So his presentation will last approximately 40 to 45 minutes. If you do have questions during the presentation, we welcome you to use the Q&A function or the chat feature. So we'll either address those at the time the question comes in, or we can wait till the end depending on the relevancy of the question, but we'll make sure that we get to everybody's questions before we wrap up today. As a reminder, we will record this session and it will be sent out to you with a follow-up email, which will also include a survey. We welcome you to share your feedback as well as any suggestions on additional offerings that we can provide to you during this time as a part of our Stronger Together webinar series. So with that being said, I'll hand it over to Dan and we'll get started.
Outstanding. Connie, can you verify we are broadcasting the slide deck?
Yeah.
Awesome. Perfect. Perfect. Welcome, everybody. It's a pleasure. I can't see any of you, but I know you're out there. First, I think before we get started, let me just offer a couple of disclosures and some introductory notes. So my name is Dan Belrud, and as Tanya said, I am the president of OneWisconsin Financial Group. Some of you on the call may know who we are because you are our clients and we exist to serve you. Those of you who may not be familiar with OneWisconsin Financial Group, I feel like I owe you not a commercial, I just owe you a little bit of background. That background starts with we are not a CPA firm, nor are we a legal firm. We are a unique financial services firm. We exist to serve two primary markets, one of which is individual families who seek to optimize their incomes, specifically in retirement. And the second group that we exist to serve is small businesses, particularly those under 500 employees. That's what makes the CARES Act conversation so relevant. It is targeted exactly to the marketplace that we serve. So typically the way that we work with our clients is that we provide things like 401ks and 403bs and SEPs and simple plans and employee benefits packages and so forth. And we believe that we're uniquely suited to serve that particular marketplace because, to be frank, we feel like it's underserved. So as we were working with our clients, as this all started to develop, the thing that we call the CARES Act and the current situation with COVID-19, one thing came really, really clear to us. And that is that there is a hunger for information around the CARES Act that spreads far beyond our client base. That is why we are doing this. We are willing to share. We are glad to share. We just want to help. So our purpose today is to offer that help to all of the small businesses across the entire broadcast area. Our offices, our furthest west office is in Hudson, so darn near Minnesota. Furthest east is in Two Rivers. North is in Green Bay. South is Plymouth. And I'm actually broadcasting today from our main office right here in Appleton. So thank you very much. I hope that sets the tone for today's conversation. So the CARES Act, in case you're not familiar with, why is it called the CARES Act? It's the Coronavirus Aid, Relief, and Economic Securities Act. Congress can't put out anything without a really cool acronym. And we want to focus today's conversation on those things that we can control. So there's a lot of things outside of our ability to impact, and we're not going to spend a single minute on that for today. We're going to spend our entire conversation around the things that we can control. If you're on the call today, you probably fall into one of these categories. Really doesn't matter where you fall in. The conversation should be relevant to each of you as long as you have employees. If you have employees, I promise you, not everything on today's call is going to be relevant to everyone, but I am really confident that there will be one or two or three things today that is applicable to everybody here. So I hope you find our conversation valuable. So I'm going to start our conversation off by a little short, super short history of how we got to the CARES Act. The CARES Act actually began with what is being referred to as Phase 1. That was on March 6th. When Congress directed some money to the FDA and the Centers for Disease Control and National Institute for Health, they sent just a couple of dollars worth of change, about $8.3 billion. They sent $7 billion to the Small Business Association to try to help with some of the disaster loans and so forth. And then phase 2 showed up on March 18th. Now, this is actually relevant to virtually anyone on the call that has employees, because here's the part about phase 2. Prior to the CARES Act, you were certainly not required to offer your employees fringe benefits like sick leave. When phase 2 hit, also referred to as the Families First Act, when phase 2 hit, it mandated that now all small employers, 500 and fewer, now must provide sick and partial sick leave to their employees. And they gave some formulas around, well, how much must you offer, how many hours. They set a max at whether the person is directly impacted, like contracted the COVID-19 virus, or whether that person was caring for a family member who had it. And there's a formula there. I've shown you some bullet points. We're not going to spend the time to dissect that because frankly, we just don't have time on today's call. But there are 2 parts of phase 2 that are relevant, and I want to point it out to you. Point number 1 is this poster that you see to the left. This poster is now required as a part of the Families First Act to be displayed in your workplace, or if you have employees who are working remotely, can't see the sign that you put up in your workplace, you're still responsible for getting them the information. Good news is it's a PDF. It's available at the Department of Labor, so dol.gov. Grab that thing, distribute it just to make sure that you can help stay out of trouble for not having done that. The other piece that's really relevant to phase 2 is at first blush, it sounds patently unfair that the government can tell a business concern that you must now provide paid sick leave, paid partial sick leave. The reason that they can get by doing that is that there are tax credits then available at the end of the year to offset those expenditures. So at least theoretically, what you wind up paying in the form of sick leave is available then to be come back into your bank account in the form of a tax credit at the end of the year. Not necessarily a phase, but just to follow the chronology, on March 23rd was when Treasury stepped up and said, so here's the deal, we're going to postpone the tax deadline. It is not an extension. Extensions require for you to file and receive an extension. A postponement simply means we just kick the date out into the future. So all of our personal returns, I think we all understand this, that they were not due on April 15th. They are now due on July 15th, as are the payments associated with those returns. But how it affected many small businesses is that it also postponed the estimated tax filings that we do once a quarter. So your first quarter filing and payment, which was due April 15th, has been pushed out to July 15th. Here's the important note. Your second quarterlies, which is due July 15th, is still due July 15th. So as it stands right now, both the first and second quarter are due on July 15th. It's also noteworthy, I suppose, that the people that may be on this call, if you happen to be from outside the Fox Valley area, not just Wisconsin, but Minnesota and Michigan, 2 areas where we also work, that those deadlines have also been extended. Their state deadlines have also been extended to July 15th. That brings us to phase 3. So phase 3 injected $2.2 trillion into the economy in three different buckets. One bucket is for healthcare providers. The second is for businesses that were affected by the COVID-19 virus. And finally, the third is employees that are prevented from working by the COVID-19 virus. We're going to focus on that middle bullet, businesses, small businesses in particular, affected by COVID-19. You may have heard, I don't know when the best time to bring this topic up, but many of you may have heard that the $349 billion that was a part of the Paycheck Protection Plan, that money was exhausted about 10 a.m. our time on Thursday of last week. There is now, it's being referred to as phase 3.5, which with any luck at all will be funded. I'm hearing Wednesday or Thursday. Don't ask me why it wasn't funded last Thursday. But my opinion, and my opinion really has no bearing, but I believe that the PPP bucket is going to be refueled. The question is when. The most common number I'm hearing is an additional $250 billion put in. And for whatever it's worth, I really have a distaste for the political wrangling that goes on way too often. And as soon as they can get that nonsense out of the way and actually get to work, those who have applied and not yet been funded, and those who have not yet applied will get funded. But I'm getting my cart way in front of my horse. So phase 3, the part that matters to us is the $377 billion that was carved out for small business loans and grants. That $377 billion is split up the way that the pie chart on the screen shows. So 2 relatively skinny slices and 1 giant piece. So we're going to go through each of these in order, smallest to largest. First is the $10 billion in the economic injury disaster loan. You will hear me refer to that as EIDL. EIDL is not a new program. It was not created by the CARES Act. EIDL is a disaster fund that was around, for example, during Katrina and plenty of other times. But it's a longstanding program. What CARES did is it funneled another $10 billion into it. That $10 billion is for the most part exhausted, and that should be a part then of phase 3.5. What's interesting though is that in order for EIDL to apply to a small business, that the geographic location where that small business operates needs to have been declared an economic disaster. I don't know that this is good news. This is actually terrible news, but the relevant news is that all 50 states are now declared economic disasters for obvious reasons. And the purpose of the loan, so clearly it is a loan, is to pay for things like payroll and fixed debts and accounts payable, or those things that cannot be paid as a direct impact of the disaster. That's what EIDL is all about. Now, who qualifies? The 500 employees or fewer businesses. So you can read the bullet points as quickly as I can read them to you. In addition, 501c3s, so charitable enterprises, 501c6s, chambers of commerce, they are also eligible for EIDL. The terms on EIDL is no employer can receive more than $2 million. And the payback rates are either 2.75 or 3.75. Why the difference? The lower, the 2.75 rate, that's for the nonprofits, the 501Cs. The 3.75 applies to those of us in the for-profit community. Payback terms are amortized across 30 years. It is not forgivable. However, there is a feature where the first $10,000 is considered a grant. Now, what I've learned, what's kind of developed here is that the first $10,000 is typically available as a rapid response. Like we'll just get you your first $10,000 while we're contemplating your application. That $10,000 appears to be based on a maximum of $1,000 per employee, full-time employee on your payroll, up to a maximum of 10 grand. So if you have 2 full-time employees, that emergency response isn't likely to be 10,000, it's more like 2,000. So how do you apply for EIDL? This is an SBA direct loan. You go to sba.gov. You'll find the application link right off the homepage. It's super easy to do. It is probably a 3 to 5 minute application process just to get it submitted. And that's EIDL. The second sliver, slightly bigger, not quite twice, of that pie we looked at earlier is the $17 billion that's been set aside for small business debt relief. This is truly a grant, and its purpose is to provide loan payment relief to those people who had SBA loans prior to February 15th. So if you already had an existing SBA loan, you know that you have a payment schedule in front of you. You know when those payments are due and how much those payments are. What the small business debt relief did is that it requires the SBA to make those payments on your behalf for a period of 6 months. Now, when I say make the payments, that means they're making the payments, the principal as well as interest and fees. It's not a deferral. It's not like we're putting your payments on pause and we're just going to push everything out for 6 months and then pick up in 6 months. Nope. During this 6 months, the SBA is actually making the payment to include the principal component. The biggest chunk, and the one that matters to most of us, is the $349 billion payroll protection plan. This is a loan program, but I'm going to put an asterisk behind the loan, and you'll see why in short order. So those who qualify, the same 500 employees or fewer, the max that any one employer can receive is $10 million. And there's a calculation to determine how much you're eligible to receive. And we're going to get into that in some detail. But it's based on 2.5 months of average payroll, and no individual employee's payroll can be considered above $100,000. Again, if that's not crystal clear, because it probably isn't, I'm going to show you an example that should clarify it. The purpose of the payroll protection plan is to keep your employees engaged, to keep them off of unemployment and keep them working. And here's the theory behind the plan. I'm not advocating whether I believe or disbelieve this. I'm simply stating what's the purpose of the program. It's to keep your people engaged, keep money in motion. The velocity of money is a key economic concept. So if we can keep money going into the households where those employees live, keep the money flowing to their families, they're going to continue to spend money to their best ability. And then 8 weeks from now, when all of the dust has theoretically settled, the presumption is that the economy will pick right back up right where it left off, because there's all this pent-up demand. People have money, they've been getting paychecks, and life is going to be grand in about 8 weeks. That's the theory. So how does this thing work? Well, I mentioned the $10 million cap. It's based on 2.5 months worth of payroll. You'll notice that there's been some changes in the interest rate associated with the loan. I'm going to give you an example of that in a minute to show you why some of those things are crossed out. But the payback period is for a 24-month payback, but it's a little bit different. Of that 24 months, your first 6 months is deferred, so no payments are due. And then the loan is amortized across the next 18. And the best part about this program and why it is so key is that done correctly, this loan is forgivable. How is it forgivable? That's where the nitty-gritty comes in. The forgiveness of the payroll protection plan comes from the 8 weeks following receipt of your loan to be used for salaries, commissions, and similar compensation, as well as sick, medical, or family leave. Also for non-payroll expenses, which include rent, mortgage interest, and utilities. Notice it's not mortgage principal, it's just mortgage interest is a part of this forgiveness formula that I'm going to share with you. Just a note moving forward, so I'm going to refer to payroll costs and other than payroll costs. Please differentiate them as we move forward. So how do you access the PPP? Well, unlike the EIDL, this is not applied directly through the Small Business Administration. This is actually considered a 7A loan, and if that doesn't make any sense to you, a 7A loan is a loan that is processed through a lender, through a financial institution, a bank or a credit union. So my guidance to you would be the best place to make your PPP loan application is through the institution where you already have an existing banking relationship. If your institution of choice does not have SBA loan authority, then you're going to have to look at other institutions, other credit unions, or other banks to find someone who is. So I showed you earlier the cross-offs of the loan interest. Why this topic has been so popular, why people, small businesses have been so hungry for this information is because it has evolved so rapidly. So the interesting times we live in find that on the 27th of March is when the CARES Act was signed into law. So it became law, clearly. But what it didn't do is it didn't provide an execution mechanism. So execution wound up falling far behind the actual law itself. So things have been changing so rapidly, all the way up through major changes happening on Good Friday, April 10th, even though the law had been in place since the 27th of March. So here's an example on April 3rd. April 3rd was the very first day that theoretically small businesses could apply for the PPP loan. There were very few financial institutions that were up and running and ready to accept the application. Some of the nation's largest lenders were not ready. For example, Fifth Third, which is the third largest SBA lender in the country, kind of griped a little bit and said there have been so many revisions by the SBA as recently as this afternoon. This is on the day the applications are being processed. So many revisions to the original program that was communicated to the country. One of those revisions was the change in the interest rate of the loans. So on the 27th of March, it was established that at 4%. The following Monday, it was then set by the White House at 0.5% or 50 basis points. The banking and financial institutions complained that said at 0.5%, we can't even afford to service these loans. So the number moved up to 1%. That's where it's landed. This is just one example of how guidance and execution have lagged behind the actual law, which probably leads to a lot of the confusion that I'm seeing from our clients and the balance of the community. So let's start talking about how much does one become eligible for? How do you determine that? So a fundamental component that goes into the formula to determine loan eligibility, which is different than the formula to determine how much of the loan you received is forgivable. So we're going to talk about them separately. They're not hard math, but we have to keep the concepts separate. Eligibility, forgiveness. Eligibility is based on payroll costs for employees. The reason employees is highlighted, by the way, this particular slide that you're looking at, this is directly copied and pasted from the Treasury's PDF application. So this is straight language out of the app. It's based on payroll compensation to employees. So if your business utilizes 1099 independent contractors or subcontractors, and at the end of the year you pay them on a 1099, they are not considered employees for the purpose of PPP eligibility, nor for forgiveness. 1099 independent contractors are considered small business owners and are eligible to apply for their own PPP loan. So it's for payroll costs to employees who reside in the United States. So if you've got a workforce overseas, that's not a part of the eligibility calculation. But the things that go into the calculation for eligibility are salary, wages, commissions or similar compensation, even tips, sick leave, there's termination pay. There's all of this stuff that goes into the calculation of how much am I eligible for. And we're going to walk through more of that here in just a minute. The way that we do this, the way that the formula instructs us, and again, there's an example in just a minute, is it says we have to calculate this thing called average monthly payroll. So we have to take all of those eligible expenses for a 12-month period. That 12-month period was originally established as 2019 tax year. Recent guidance that came out on Good Friday is it can be the 2019 tax year or the 12-month period immediately preceding the date of your loan application. So we can either use January 1 through 12/31 of 2019, or we can use, today's the 20th, we can use the 21st of April through today as our 12-month period, whichever one is more advantageous to you. From a practical standpoint, it's likely easier to provide documentation on calendar 2019, but that's for you and your accounting team to help figure out. The monthly payroll that we calculate, though, has to exclude any compensation paid to a single employee over $100,000. So if you have an employee who earned $150,000, you can only count the first 100 as a part of your average monthly payroll. New businesses, there's also a twist for you. We're not going to spend a ton of time on that. If you need help, reach out to us. We'll do what we can. Your accounting resource is really the one who's going to understand that. Just know that there's the ability for new businesses to still qualify. There are going to be two documents that I know you're going to need when you do your PPP application. One of them is the IRS Form 940. So that's your federal unemployment tax return that's done at the end of the year. There's also the 941. These are the quarterlies that are supposed to be done on the 15th of each quarter. The 940s and the 941s are important, and you're going to want to have them available as you do the application. This is another slide where the information on it was actually copied and pasted directly off Treasury's application. And I want to walk through because there's a couple of details here that are important. The whole idea behind certifications is that it makes the PPP loan different than anything I've ever seen from SBA. Typically, when one applies for an SBA loan, there is a lot of validation that the lender is required to do to make sure, so auditing the financial documents and so forth that are part of your application package. The PPP loan is specifically not validated by the lender. It is instead certified by the borrower. This is as close as I've ever seen to the honor system. So part of what one must certify, these are not all of the certifications from the application. These are just some that I wanted to call out because I feel that they're important. One of which is that you're acknowledging that the funds will be used to retain workers and maintain payroll. That's the primary purpose. It can also be used so there's non-payroll expenses I mentioned earlier, mortgage, interest, rent, or utilities. The idea here is that if the primary purpose is to keep people employed and your business needs to have the lights on and be current on rent, then money has to be available to be used for that as well. We already talked about how the applicant will provide the lender documentation, right? That's the borrower certification portion. And that's why we need the 940 and the 941. And then finally, there's an understanding that when you sign the application, you're acknowledging that loan forgiveness will be provided for the sum of documented payroll cost, as well as the eligible non-payroll cost, so long as not more than 25% of the forgiveness can be for non-payroll costs. I think I have a more simple way to say that. I'm going to show it to you in a minute. So let's walk through a hypothetical example. I actually have 6 different scenarios that I can walk you through in short order, but they're going to be based on this one hypothetical small business that has 7 employees. And their cash compensation for the year, you can see there are 7 of them. Only 2 of them have exceeded that $100,000 threshold. It's Bill and Mary. So to go through the process and figure out our eligibility, to go through that calculation, I want to line all 7 employees up and I want to add their payroll for the year. In this example, I come up with $515,000. But remember, 2 of our employees earn more than $100,000 and we can only count the first 100. So in my eligible column here on this slide, I'm showing we're accounting, we're dialing down Bill and Mary's compensation to $100,000. So $450,000 is the $455,000 is the eligible compensation that can be plugged into the formula. So if we start with the 455, we're going to divide that by 12. Why? To get our average monthly payroll. And then we're going to multiply it by 2.5. Why 2.5? Because that's what the act said, 2.5 times average monthly payroll. So in this example, this small business is eligible for a PPP loan not to exceed $94,792. But we want to keep that ratio, forgiveness ratio thing in mind as well if it's our intention to have as much as 100% of the loan forgiven. So of that $94,792, no more than $23,698 can be spent on the non-payroll expenses. Let me say that differently. At least 75% of that amount, $71,094, should be spent on payroll to be in the good graces of the forgiveness formula. The easiest way I've found to think about the forgiveness formula is that there's an either or scenario. So my loan can be forgiven based on either what I spent on payroll, rent, interest, and utilities, so long as no more than 25% was spent on payroll, I was spent on non-payroll, or take my payroll expenditures and divide by 75%. Note that I did not say multiply by 75%. I said divide by 75%. So let me show you a half a dozen different scenarios. I think they're easy enough to understand. Want to walk you through them just to try to give you a working understanding of how this stuff works. So we're using the same loan numbers as we had before, a total loan of $94,792. And if I want to have it fully forgiven, I'm going to spend the $71,094 on payroll and only $23,698 on other than payroll. So let's look at scenario one. In scenario one, I only spent $50,000 on payroll and I spent $44,792. So I spent all of the $94,792 on eligible expenses. I just spent them in the wrong ratio. So since I can never have more than payroll divided by 0.75, it means I will have 66,667 forgiven. I will have 28,126 not forgiven. So what happens to it? Well, it's financed at 1% for 24 months. Here's scenario B. I spent the $71,094 on payroll, clear there, but I only spent $10,000 on the non-payroll expenses. That means that on the eligible expenses, I spent $81,094. I cannot be forgiven more than I actually spent on qualifying expenses. So I'll be forgiven the $81,094, meaning there's $13,698, 1% for 24 months. Scenario C, I spent the $71,094 on payroll. I spent more than the $23,698. That's okay. By the time I do the math, I've satisfied the requirement for the payroll expenses. The fact that I spent more on the non-payroll expenses doesn't matter. I can only be forgiven as much as the loan. So my loan forgiveness will end at $94,792. Scenario D is really easy to understand. I spent $150,000 on payroll. I had a loan of $94 and change. I spent far more on payroll than I was required. That's the only data check I need to do. If that's the only information I know that all $94,792 is forgiven. The last two scenarios are sort of related. So in the first one, I only spent $30,000 on payroll and I spent $10,000 on utilities. Here's the good news. I spent it in the correct ratio, but since I can only be forgiven as much as I spent on qualifying expenses, I'm only going to be given the $40,000, forgiven $40,000, meaning $54,792, the balance financed at 1% for 24 months. Last example, I spent the same $30,000 on payroll. I spent nothing on rent, utilities, or mortgage interest. Once again, I can only be forgiven as much as I spent on eligible expenses. I can only be forgiven the $30,000, the balance being financed. Here's a part that is not shown in these calculations that are going to matter, particularly in scenarios E and F, if your scenario looks anything like this. And that is that there is a portion of the forgiveness formula, a second portion, that is based on FTEs, full-time equivalents. So during your qualification, during your eligibility period that we're presuming to be calendar 2019, you had a certain number of full-time equivalent employees. When you add all your full-timers and your part-timers together and you divide it all by 40 hours each, etc., this is how many full-time, this is how many FTEs you had in your business. During the 8-week period that these scenarios are gauging, you are required, in order to gain full forgiveness, to have the same number of FTEs. So what it would appear in scenarios E and F is that you didn't keep on your full number of FTEs during the 8-week period. That is going to cause a haircut on your forgiveness. So how it works is, once you've calculated your forgiveness, as we've done here, let's say that you, during the period of time that for eligibility purposes, let's just assume that you had 12 FTEs, but during the 8-week period where forgiveness is being measured, you only had 8 FTEs. That means you've only kept 75% of your FTEs. They're going to take your calculation from this page and they're going to hack 25% off because you didn't meet the FTE test. I hope that makes sense. Remember, the purpose of the program is to keep your people employed, keep all the people that you had employed. Real quick note before we step forward is A very frequent question that I've been getting is, well, what happened if I laid people off and now I'm getting my PPP funding? The answer is bring them back. That's what it's intended to do. What happens if somebody who was on the payroll last year quit, left, went somewhere else? Replace them, replace their FTE. Here's the third question from this kind of same line of thinking is, well, what happens if during this 8-week period I maintain all my FTEs? What happens if I get into week number 9 and I lay some people off? And the answer is there's no provision against that as a part of the PPP program, PPP loan. We are now, I'm going to transition off the PPP because there are 2 or 3 other provisions of the CARES Act that interact with things like PPP and Families First and all that other sort of stuff. And I want to make sure that we've got this information, at least that we've got it out on the table so that we're thinking about how these things interact. So one thing to know is that the CARES Act contained a provision for net operating loss carryback. So in 2017 was when the current tax bill was passed, meaning our current tax rates. It's often called the Trump tax bill. I don't care what you call it. It's our current tax situation. But one of the changes that happened as a result of the 2017 law is that it prohibited a business from carrying net operating losses backwards into previous years more than 2 years. So what that means is if I have a net operating loss this year, I could carry it, this year being 2019, I could carry that back to 17 or even 16, but I couldn't carry it any further back. What this provision of the CARES Act does is it essentially pretends that that provision of the 2017 law never existed. It allows us to carry it back a full 5 years. So if I can look back at my 2018 tax return and my business had a net operating loss, and I couldn't carry it back to 17 or 16 just because maybe I had profitable years then, I can go all the way back to 2013, 5 years back, and recalculate any or all of those tax returns to see if that'll provide me with a refund. That's going to provide short-term stimulus. Similarly, I can carry 19 all the way back to 14, recalculate if that's to my benefit. And for 2020, I can do the same thing if I generate a net operating loss this year. Certainly, this is something that your tax professional is going to be all over. My hope in bringing this to your attention is that if I can get your brain wrapped around it, when you go sit down with your tax advisor, you'll have been exposed to this enough to understand what he or she is trying to explain to you, why you may want to do that recalculation. My understanding is that those refunds, should they develop, that they are being processed in days, not weeks. So this could certainly provide a cash influx into your business if you're eligible. Another important tax consequence, tax feature of the CARES Act is the ability to delay employer payroll taxes. So I'm talking about the employer half of Social Security and Medicare. So normally we have to make those payments throughout the year. What this feature of the CARES Act allows us to do is it allows us to temporarily suspend making our payments to the IRS. They're not forgiven, they're just postponed. So if I stop paying the payroll taxes from now till the end of the year, I have to pay those back. They have to be paid back at no interest or penalty in a 50% chunk due on New Year's Eve of 2021 and the balance New Year's Eve of 2022. Here's the catch though. While this may sound beneficial, keep in mind that it may prohibit you from taking a PPP loan. There's also an employee retention credit. So once again, a tax credit is a dollar for dollar offset against any taxes due. It is a refundable credit, meaning even if you have no taxes due, you can still receive the credit. How this works, the purpose of the employee retention credit is again to keep people employed, but it's special in that it's for those businesses where they were either fully or partially suspended due to COVID-19 or where gross receipts were reduced by half or more when compared to the same time last year. So the amount of the credit is up to $10,000 worth of compensation to any employee, a 50% credit. So let me say that easier, cleaner. The amount of the credit is not to exceed $5,000 per employee. Now, you are eligible to receive the employee retention credit as well as the deferred payroll taxes, but neither of those will allow you to also take the PPP loan. Important feature, I probably should have mentioned it earlier, I apologize. Yes, you can receive both the EIDL and the PPP loan. You can receive both of them. So making application to both is not a problem. But with the, what I'll call the no double dipping rule, means you cannot use the same dollars of expenses to validate your receipt of an EIDL loan and your forgiveness for a PPP loan. For example, if you paid a given employee $5,000, you can't use the same $5,000 to justify your EIDL loan as well as justifying your PPP loan forgiveness. I've really talked fast. We are at 42 minutes since we kicked off. Tanya, do we have any Q&A that I need to address before I start kind of getting to the wrap up and what I believe to be a really important part of the CARES Act? I do have a couple of frequently asked questions. I've actually pulled this. This is what Treasury refers to as their interim final guidance. It does provide an area of clarification, though. So this is the document that just came out on April 10th. That was Good Friday. And it clarified something that surprised virtually everybody. If you'll remember, the compensation in excess of 100,000, I'm going to start using that example. So the question that was posed to Treasury and what they came back with on the 10th of April, so 2 weeks after the law was already enacted, is the question was, the CARES Act excludes from the definition of payroll costs any employee compensation in excess of an annual salary of 100,000. Does that exclusion apply to all employee benefits of monetary value? So remember, the things that go into the calculation are things like if we as the employer pay the health insurance premiums for our employees, or if we provide a matching contribution to their retirement plan, right? All of those are payroll costs, but we're told that we can't count anything over $100,000 of total comp. Here's what Treasury said. They said no. The exclusion of compensation in excess of 100,000 annually applies only to cash compensation, not non-cash benefits. Let me show you how this really, really matters in the calculation of your eligibility. And for those people who applied prior to April 10th, they didn't know this. Remember Bill and Mary? So they had compensation of 140 and 120. So we thought we had to start counting their calculation there. Well, actually, we had to stop counting their cash compensation there. But let's just say that we made health insurance premiums payments on their behalf for $10,000 each. And we also matched $10,000 worth of contribution to their retirement plans. That actually takes that eligibility number up to 120. That's significant. That's $20,000 times 2 in that example. That's another $40,000 that gets plugged into our eligibility calculation. This is obviously something that you're going to want to make sure that you're working with your accounting professional on. But please understand that if you stop your calculation at 100 when any of those other circumstances apply, you may have left application money on the table. And as of right now, I've not seen any guidance on how to amend an application. Tanya, was there anything? Are you seeing anything Q&A?
Yeah, we do have one question, Dan. Scott Peterson is wondering, if I have a part-time employee that is part of the PPP calculation of 1, can I pay that person more in hours during the 8-week period in order to use up all of the 75% and 25% of my lease?
As I understand the question, and of course he's going to consult his accounting professional, but as I understand his question, the answer is yes, because you have to have at least as many FTEs during the 8-week forgiveness measurement period as you did during your eligibility calculation period. What he just told me is he had half an FTE for 19, and he's going to have a full FTE for the 8-week validation or forgiveness calculation. that puts him in good graces. Although remember, his eligibility calculation is only based on that 1/2 FTE. So I'm sure he gets that.
Perfect.
Great question.
Good. And then Jean is wondering, as we are figuring out, or as we're figuring our payouts for PPP, do we count Medicare and Social Security?
Great question, and the answer is no. I could read it off the Treasury's clarification, but our payroll taxes that we pay to the on a federal level, those are not considered. That's an awesome question. I'm glad Jean asked it.
Perfect, thank you. Those are the two that I had pop up at this point. So
all right, so we'll have one last opportunity for Q&A. I want to wrap up with one what I believe to be a really important topic. So I've been hosting these webinars. I honestly don't remember how many. It seems like every day for the last couple of weeks I've been doing one of these sessions. And at the same time, one of our senior advisors from our Green Bay office, her name is Miranda Bondi. Miranda has been running a series of webinars that are targeted towards individual families and what the provisions of the CARES Act means there. Everything from unemployment to the $1,200 stimulus checks and all that sort of stuff. There's an area where the individual benefit conversation and our small business benefit conversation where they overlap. And that is in particular the implications of the CARES Act on retirement plans, specifically 401ks. There's also some applicability to IRAs, but I'm going to focus on 401ks in this particular instance. Here's what happened as a part of the CARES Act. When a small business establishes a 401k plan, there's a plan document that gets written that describes what the plan will and will not do for its employees. It includes things like matching and so forth. It will include a provision for whether or not an employee may take a loan against the balance of their 401k plan. So that's not in every plan, but if the plan allows for it, what the law says is that so long as the plan allows it, an employee can borrow the lesser of 50% of the account balance or $50,000. What the CARES Act did is it said, with the stroke of a pen on the 27th of March, is every 401k plan, whether the plan document says so or not, you are now allowed to borrow against your 401k, and the amounts changed. You can borrow up to the lesser of 100% of your 401k balance or $100,000. At the same time, what the CARES Act did is it allows for what I'm going to refer to as in-service withdrawals. So typically, in order to move your money out of your 401k to somewhere else, you either have to have reached age 59 and a half and your plan document allows for in-service withdrawals, or you have to have a qualifying event like you quit or get fired. That allows you to move your 401k money, put it into an IRA, or do something different with it. The CARES Act said now, regardless of what your plan document said, every 401k allows in-service withdrawals. And regardless of your age, it eliminates the 10% penalty that would normally be in place if you simply cash the money out. My fear is that those small businesses who have 401k plans and the owners participate in it, or if they have SEPs or simples, that they're going to take the opportunity to pull the money out without a strategy behind it. Just because we have the ability to do something doesn't mean we should. Similarly, let me say that there are cases, and I can think of plenty, where actually taking the money out and paying taxes on it now might actually make sense for certain plan owners. Because here's the provision that the CARES Act made. It said if you do one of those in-service withdrawals and just pull the money out, you can avoid the 10% penalty. But you still have to pay tax on that money. You get to spread that $100,000 worth of income across 3 years, 2020, 2021, 2022. That has significant positive impact to those people who choose to do that. Or here's what else the CARES Act says, is it says you can wait till 2022 and you can just put the money back and you'll owe no tax at all on that entire transaction. Well, that's kind of weird too. Here's why all of this matters. In case I've confused you, like, why is he talking about this stuff? Here's the big picture. And I want to make sure, I view our job when we work with our clients is to make sure that we don't make short-term decisions that have long-term negative consequences, nor do I want to see my clients bypass windows of opportunity that they may never get back. And here's where all paths lead, at least in my mind. When we came into this train wreck of COVID-19, and I apologize for calling it that, but none of us are really happy that this thing happened. We came into this with a national debt sitting at $24 trillion. By default, we know that the CARES Act, the $2.2 trillion that went into CARES, we know that added at least $2.2 trillion to that number. Some people that I've read and listened to estimate that by the time it's all said and done, we could be adding a total of $6 trillion to the national debt, from 24 to as high as potentially $30 trillion. Here's my question. You think taxes in the future are going to be higher or lower? Because if you're one of those people that thinks that taxes in the future are going to be higher, the CARES Act is providing us opportunities to look at each individual scenario and say, how does this affect me? And how do I best position myself so that I don't pay more tax than I necessarily need to? I hope that made sense. If it doesn't, or if you just plain want to learn more, here, let me share our contact information. I mentioned our 5 locations. You can always email us. The easiest email to use is info@onewisconsin.com. It's spelled out O-N-E Wisconsin. info@onewisconsin. Feel free to use that. Feel free to use any of these telephone numbers if you recognize any of those names. You can certainly call me at the Appleton office. Bill or I'll be happy to get back to you. Yeah. Is there anything else before we run out of time, Tanya?
Yes, we do have one more question that came in from Elizabeth. She is wondering, what happens if you apply for the PPP loan, receive it, and then you decide you don't want it? Same with the EIDL. What might be the ramifications?
So there's nothing wrong with paying either of them back early. Nobody's going to stop you from doing that. I guess as those words are coming out of my mouth, my sense of fair play is also coming to mind. And here's what I mean by that. If you don't think you need it, I question whether you should apply. And here's why. There are a lot of people who are right now feel like they're standing in line with empty hands because the piggy bank ran dry last Thursday, and they need that money or their business will not survive. If you happen to have been one of those people in line in front and you took that money and you didn't need it, my sense of fair play says, I wish you hadn't done that. I have strong emotion around this idea of supporting small business. Clearly, I am one of those small businesses. We are the engine that keeps the economy running. I have no axe to grind with Ford and General Motors and all of the big businesses that are suffering as well. But I know what carries this economy on its back, and it is small business. So I apologize if I interjected too much personal philosophy into a relatively simple question. Pay it back, if that's your case.
Okay, thank you. To follow up on that, if the above scenario happens and you return it, what happens to the 50% tax credit?
So I'm just trying to contemplate the question. So the 50% tax, the answer to that is, maybe I understand the question now. If you return it, can you then take the employee retention credit? That is a great question. I'm going to defer answering it because I think I know the answer, but I'm not 100% sure. So the question, as I understood it, once I processed it, is if I take the loan and then pay it right back, can I then instead use the employee retention credit because the two don't play well nicely together? I'm going to defer that one to that individual's tax professional.
Okay.
Sorry for taking the easy way out. I just don't want to give wrong information. There is an interesting provision though, and I'm watching time. There is an interesting provision that I learned though recently, which is if you so normally loan forgiveness of any type is considered taxable income. PPP loan forgiveness is not. At the same time, what I can tell you is, according to current guidance, the payroll expenses that we use to justify that forgiveness, those are still deductible. So if I can, it's theoretically possible to actually make money by receiving the loan forgiveness. Here's how that works. Let's say that you received $100,000 in PPP loan, and you used all 100 of it on payroll. Well, that's really pretty clear, right? It's forgiven. So you get $100,000 influx that is not considered taxable income, but you paid $100,000 in payroll expenses out. And if I assume, just for the sake of easy math, if you're in a 30% tax bracket, you just made $30,000 the way that the guidance currently exists. Now, will that change? I don't know, because what the tax community is telling me is that there's no provision, there's no way to calculate that, to capture that back on a tax return. We'll have to keep an eye on that and see if that actually plays out. That actually sounds like not fair play to me. Like it's something that's been overlooked, but as it exists right now, yeah. Anything else?
Yep, one last question. Can a 501c3 with no paid employees qualify for the PPP?
You garbled just a little bit. Can a 501c3 with what?
With no paid employees qualify for PPP?
I don't see how that can happen, because you don't have a way of calculating an average monthly payroll. Your average monthly payroll is zero. 0 times 2.5 times is still 0.
Got it. That's all that I have through either the chat function or the question function. So if anybody does have anything else, now is the time to send those in. Otherwise, we will wrap up. I want to thank you again, Dan, for being here today. Oh, looks like we do have one more question. Hold on one second. Oh.
Under the wire.
Jean raised her hand, but I don't see a question come in, so I'll give her just a second to type. But again, Dan, thank you. A lot of information. I understand. I mean, just myself listening to this, there's just so much out there to understand. So hopefully everybody found this.
We are happy to be a resource. Once again, we're not trying to play the part of CPAs or attorneys. Those people do their jobs and they do them well. If we've succeeded here today, my hope is that we've clarified some things so that when you do finally have the ability to counsel with your team, that you're able to that you've been spun up on the learning curve a little bit faster. That's our hope. Anxious to help anybody on the call. Feel free to reach out. Love to hear from you.
Great. And we will, as I noted earlier, we will send out a follow-up email to everybody who was registered or on the webinar today with contact information for Dan. If you do have additional questions for him that you'd like to ask as a follow-up, you're welcome to do so. And we hope that everybody will consider joining us later this week. We have a lot more webinars coming at you with various different topics. Tomorrow we'll be discussing leveraging video to help keep your business relevant during this time. That'll be taking place at 8 a.m. Wednesday,
that's a great topic.
Yeah, it should be really good. We everything is social media right now, right? So everybody is trying to reach out digitally. So hopefully that's well attended. We invite everybody to come back and join us for that. And then Wednesday, we're inviting Jake Woodford, our Appleton's new mayor, to our first chamber chat. So that'll be more conversational and just discussing with Jake, his plans for the city as we move forward. Thursday, we have a really great webinar that's taking place, the 411 on COVID-19. We have some county health officials that'll be on that call, as well as Dr. Andravi and Dr. Nichols, just talking about the virus itself and allowing the community to ask questions anything that may be top of mind for anybody at the current moment. So hopefully everybody can join us this week. We look forward to seeing you all again. And if you do need additional information, again, the best place to find that is at foxcitieschamber.com. So I think we'll wrap up then. Thanks again, Dan. And if anybody needs anything, feel free to reach out. We're happy to help in any way we can.
Thank you.
Yep. Have a great day.